Angela, over to actually, you know what? Angela is home with the flu today, so it is just me this morning. No co-host, no safety net, just Iggy and the numbers. Get well soon, Angela. In the meantime, let us get into it. The SpaceX IPO is taking up all the oxygen in the room this morning. $10 billion in orders before a single share has even traded. The question I want to answer today is simple. Does that kind of hype belong anywhere near a Singaporean retirement portfolio? Or is it just another rocket we should let fly past us? Keppel announced this morning that the sponsor is securing data center land in Seoul. That sounds like growth. And at the sponsor level, it is. The sponsor is laying pipe. But the question that matters for REIT unholders is whether Keppel DC REIT has the balance sheet to pick that pipeline up when the time comes. Right now, it does not. The REIT is sitting in a conditional zone under my framework. The yield is not clearing my 4.7% hurdle. That means for every dollar you invest, you are getting less than 4.7 cents back in dividends per year. And gearing is trending upward, not downward. Here is the part that gets missed in the excitement around acquisition pipelines. When a REIT takes on a new asset with stretched gearing, it often comes back to unit holders with a rights issue to raise fresh capital. So instead of collecting your dividend in peace, you are being asked to top up your investment just to avoid dilution. Sponsor momentum is great for growth investors, but for a retiree drawing down a dividend portfolio, that is not growth. That is a hidden cost arriving at the worst possible time. The headline says expansion. The fine print might say, please send more money. Moving to the currency markets, that has breached the psychological 14,000 mark against the Singapore dollar. For any SGX stock earning significant revenue in rupiah or ringgit, the home currency tailwind in their income statement starts to look much thinner. When your neighbor's currency is losing ground, it does not stay next door. Reported profits could shrink even if the underlying business in Indonesia or Malaysia is doing fine. Your dividends could take a hit without any local bad news at all. The names most exposed are the ones with heavy ASEAN revenue concentration stocks where Indonesia or Malaysia represents 30% or more of their top line. When the rupiah slides, that 30% of revenue is worth less in Singapore dollar terms when it gets translated back into the accounts. The dividend you receive is calculated on reported earnings, so the FX hit flows straight through to your payout. This is not a crisis today. But if the rupiah stays weak through the next reporting cycle, you will see it in the numbers. That is the macro flag to keep on your radar. For the big three banks with ASEAN exposure, this is not a zone change trigger on its own, but it is worth tracking as part of the total picture. Now back to the rocket. The Business Times is running guides on how Singaporeans can get access to the SpaceX IPO. That makes it feel like an opportunity everyone else is jumping on. Here is the forensic reality check. SpaceX reported nearly $5 billion in net losses last year. $5 billion in red ink. At the targeted valuation being discussed, the price-to-sales ratio is roughly 94. That means the market is valuing the company at 94 times every dollar of revenue it brings in. For context, a normal mature company trades at 2 to 3 times sales. You are paying $94 for $1 of SpaceX revenue, and that revenue is still attached to massive losses. Here is the opportunity cost framing I think every Singaporean investor should run before touching this. The same capital you are considering putting into SpaceX at a 94 price-to-sale ratio with no dividend and $5 billion in annual losses could be sitting in a Zone 2 SGX stock yielding 5% or more, with a fortress balance sheet, CPF investment eligibility, and a dividend that has been paid consistently for years. That is not a boring choice. That is a retirement-grade choice. The framework does not change just because the logo has a rocket on it. You cannot afford to lose capital chasing a story. As always, this is forensic education, not financial advice. Every investor's situation is different. Do your own due diligence, and if in doubt, speak to a licensed advisor before committing any capital. Full breakdown is live on Substack for Iggy's elite investors. Quick takes land on Telegram first. Links are in the description. See you in the next one.